Welcome back. My name is Chris Gosselin from Australian Fund Monitors. Today I'm talking to David Franklyn from Argonaut Global Resources Fund. David, welcome.
Thanks, Chris. Good to be here. Yeah.
So, David, just give us a bit of background. You're based in Perth, which is sort of the resource capital of Australia. Where would we be without it? The budget would be in a lot of trouble without it. Tell us more about the fund and how long it's been going and the management company.
Yeah, sure. It's probably worth just talking about Argonaut more broadly. So what's unique about Argonaut as a group is that it's got a funds management business, which is the newest part, but it's got a stockbroking business and a corporate advisory business. But the unique aspect is it's entirely focused on the resource sector. So we live and breathe resources across the group. We have a lot of mining sector expertise, and that certainly helps us in the funds management business.
Okay. And the actual fund itself, how long has that been run?
Yeah, so Natural Resources Fund has been going for just over 5 years. We started in January 2020, and our average annual return is about 25%, which has been
impressive.
Yeah.
And is it just investing in underlying resources, or it is in companies that are mining, or a combination, or where does the resources, the actual digging it out of the ground finish, and where does the fund finish?
Yes. So the fund invests in listed companies, listed mining companies, and that can be producers, developers, explorers, and 20% of the fund can be invested in global mining companies. So we typically have between 10 and 25 stocks in the portfolio. Our positions are typically between sort of 4 and 12%. So it is high conviction. The process is really, we look for the key resilient themes going to impact on the resource market. From there, we choose the commodities that we think are best placed to capitalise on those themes. And from there, we look for the best quality, best value companies that are producing or looking to produce those commodities. So that's kind of the system and process that we use. Yep.
So do you invest in emerging miners or explorers as well? Is it across the board?
Yeah, exactly. So it can vary, but we can invest really from the biggest companies. So at the moment, we own BHP, but we also own companies with a market cap of 20 million. So really across the spectrum of resource companies, and that can include producers, developers, explorers.
Okay. Yeah. And mining services? Do you get into mining services?
We do, yeah. We can own mining services as well. It's probably never going to be sort of more than 10% of the portfolio, and at times we do own them. We don't own any at the moment, but what we're often looking for in resources is some defensive areas to kind of hide when the market's under pressure. And the positive about mining services is often their businesses are linked to production rather than the commodity price. So it gives you a bit of protection in certain market situations.
Okay.
Yeah.
What's happening at the current time in the resource market? What do you like and what are you avoiding?
Yeah. So, I mean, maybe if I step back and go through, that process. So from the key resilient themes, what I think is interesting is, as I've been saying, we've been going for over 5 years, and the key thematics are unchanged, right? So when we started, the two big factors were energy transition and the fact that we're entering a period of increased geopolitical risk. And I think those factors are still in place, notwithstanding there's some nuance around them. So with energy transition, really for the first 3 years it was all about electric vehicles. I think that's now broadening out. So it's battery storage, it's grid power, so things like nuclear coming into the picture. And then really on the supply side, one of the implications of energy transition was you saw government policy really impacting on some of the areas of the energy market, such as gas, where demand stayed the same, but because of government policy, supply came off, and so that also created some opportunities. So we've kind of adjusted the portfolio depending on how that sort of market has evolved. And then on the geopolitical risk side, we sort of see gold and oil and gas really in that sphere. And I think very clearly the world's a dangerous place, right? So there's a need for gold. I think what you're seeing is a lot of ongoing conflicts. I think the US and a lot of the Western economies have a lot of debt, which they need to deal with. And increasingly, you're seeing a separation of the Western economies from the others, and that's meaning that not everyone wants to hold a whole lot of assets in US dollars, and so gold's really come back into favour. A lot of central bank buying, and we see that's going to continue. So it's really that store of value and gold's role as a global currency. Which,
so,
yeah.
Dare we mention Donald Trump? I mean, he impacts everything to do with our lives and geopolitical. Yeah. Is that an impact for you in the resources sector?
Yeah, I think it is, and tariffs is sort of top of mind at the moment. So I think, and there's positives and the negatives. The thing with Trump is, while he's there, there's always going to be volatility and uncertainty, and that's never good for investment markets. So you've got to kind of get through that. But if you stand back, well, and a good example of that is copper. So when he was talking about tariffs, it was all about how he's going to put a tariff on copper, and so you had a lot of copper cathode being moved into the US in the expectation that a tariff was going to happen, and then when the tariff details came out, copper was excluded, and cathode and even some refined products. So that's slowly unwinding. But if you look at what tariffs are trying to achieve, it's to rebuild a manufacturing sector in the US. And I think that's going to require a lot of commodities. And so I think that's very positive for resources. I think the other factor is, one of the real constraints over the mining industry globally is just the timeframes to get new projects developed. So a copper mine in the US from go to woe will take you at least 15 years. And so when you're trying to remodel your economy, that's a major constraint. So those timeframes look like they're going to come down pretty significantly. And I think what we're also seeing is other global economies taking note and also recognising that there's demand for these commodities, and you can't just buy it all from China. I think increasingly the supply chain configuration is important. So the fact that places like Australia and Canada and the US need to be able to bring projects and mines on stream much faster, which I think is positive. Yeah.
So is it fair to say there are good tailwinds for resources generally across the board, or is it specific?
So I think generally you're right. There's good tailwinds. The last couple of years have actually been reasonably tough in the resource market, but I think across a whole lot of different levels, resources are looking good. So firstly, if you look at the macro, you've got interest rates likely to trend down in the US, which is very positive for long-term assets. I think you're seeing China increasingly looking to stimulate their economy, and they're really the major global buyer of commodities. You've had the European Union commit to a lot of expenditure and growth, which are a group of economies that have really been pretty comatose for the last decade or so. So that's pretty encouraging. And I think what we'd all like to see is a cessation of the conflict between Russia and Ukraine, and then I think what you'll see is a whole lot of capital and development going to Ukraine and rebuilding their economy. So I think there's a lot of really positive drivers of global growth and commodity demand, which we're optimistic about.
So these are global thematics, and you can implement buying and selling here to fit in with those global thematics.
Yeah, that's right. So if you bring it to a commodity level, the commodities that we like, really the last couple of years, it's probably all in resources, it's all been about gold for the reasons we've talked about. A lot of uncertainty, a lot of conflict, and so gold's been really the standout. If you look forward, it's a number of commodities that we really like. I think, copper is really the standout commodity over the next 5 to 10 years. In Australia, it's relatively difficult to find good quality copper producers. Sandfire's done a great example, but kind of everyone's piling to that, so valuation-wise, it gets a bit stretched. There's a couple of interesting developers like Firefly, that's a project in Canada. But, we kind of utilise our ability to buy a bit of stock offshore that, we've bought, Teck and Anglo American and Ivanhoe, which are really large-scale copper producers. And then the other copper producer here is BHP, which obviously recognised as the leading iron ore company, but I think its latest results really showed that, something like 45% of its underlying earning, EBITDA comes from copper, and I think in a couple of years' time it'll probably surpass iron ore. So, that's also an emerging copper producer, notwithstanding produces 2 million tonnes per annum and will be the second largest producer globally, which is also interesting.
Really interesting to talk to you about this. I mean, you obviously live and breathe resources. Quite often we tend to forget resources with all the focus on tech and AI.
Yeah.
So it's actually really interesting to bring it back to what's driving what people would call traditional economies and manufacturing.
Well, I think you're right, and if you look at investment markets, where all the capital has gone into in the last couple of years, it's technology and it's bank. Technology in the US in particular, banks in Australia. And resources have been a bit forgotten about. But when you stand back and you go, well, where's the value opportunity and where's the growth opportunity? I think resources really stands out. Now you need to be selective, and it's the thing about resources, it requires specific expertise. It's not just an analysis of a spreadsheet. It's understanding ore bodies, grade, costs, because there's controllable factors, but there's uncontrollable factors such as the commodity price and exchange rates, which are big factors. So you really need to make sure you're buying good quality projects to deliver a good long-term return. Yeah.
David Franklyn, many thanks indeed. We'll look forward to seeing you again soon.
Thank you, Chris.
Thank
Always
you.
a pleasure. Thanks.